Once again, welcome all of you. Myself, Savita Mali, lecturer from Adarsh Institute of Pharmacy, D Farm Vita, present here a third presentation on topic number 8, banking and finance. Already, I completed two presentation on this topic. In first presentation, I was explain commercial bank, and in second presentation I was also explain different types of bank. Then this is third presentation. In this presentation I will explain you the finance and the financial planning. Finance and finance means provision of money at any time when business require it. In business we need finance, that means capital, which can be developed or arranged by ourselves, called as own capital, or we can take it as a loan. So provision of money at any time when business required it is called as finance. Then for running of the business, proper financial planning is necessary. Financial planning means to ensure that adequate funds are available to business firm for its proper utilization and administration. That means whenever business need money, you can arrange it, but its proper planning is necessary so that adequate amount of fund can be remain available for proper administration of business. Financial planning is necessary to estimate capital requirement for the smooth running of the business. Then second, to determine forms and amount of securities to be raised, to lay down effective policies, proper administration of the financial planning. Financial planning is also flexible and it can arrange money as and when business need it. So your financial planning should be become economical and it provide maximum utilization of fund. The proper financial planning covers following points. It means total finance required for the business, proper utilization of finance, controlling and handling of activities related to collection of and repayment, then determination of profit and its proper utilization, and ways and means necessary for achieving target of the financial planning. So by proper planning of your finance, you can achieve your goals and aim of your business. There are different types of finance, that means fixed capital, and second one is a working capital. Working capital is required for a business for purchasing of raw material for for to meet day-to-day expenses like salary, wages, rent, interest, etc. So it is also called as revolving or circulating capital. Working capital is a need of a business, and there are second types of capital is a fixed capital. It can be invested into the fixed assets like land, building, machinery, furnitures, etc. Then working capital again divided as variable working capital and permanent working capital. Variable working capital can be available into the your business for proper running of your business. Permanent working capital is required to pay the salaries, wages, rent, taxes, etc. But variable working capital is uh, need when you want to expand your business or make the changes in your business. So it is a extra fund required for a business. Again we can divided as working capital and fixed capital. As fixed capital is invested into the fixed assets That is assets that are durable in nature. That means it can be invested into plant, machinery, buildings, lands, and devices, patent, copyright, and goodwill, etc. Then fixed capital uh, can be available by shares, retained earning, term loans, lease financing, and debenture issue. Then next one is a working capital is obtained uh, by current asset and current liabilities. Current asset means property, inventory, cash, etc. When we minus current liability from current asset, we get the working capital, which is in the form of cash, short-term debts, or operating expenses. So these are the various types of capital. That means fixed capital or the working capital, and this finance can be obtained as a own capital or the loan capital. So this finance own capital can be arranged by sole proprietor or partner or shareholder themselves, but loan capital can be arranged by taking the loans from various institutions. So this loan capital can be divided as short term loan capital, long term loan capital, and medium term loan capital. Long term loan capital is for 10 year or more than 10 year. Medium term loan capital is for 3 to 10 year, and short term loan capital is for 2 to 10 years. Um, then long term and medium term loan capitals can be arranged by issuing of shares, issuing of debenture, plowing back its own profit, public deposit, loan from specialized institute, or term loans from various bank, etc. We can see this one by one. First one is shares. Shares means when capital requirement for a business is divided into large number of equal part is called as shares. For every business there is a need of capital, and when this capital is divided into short part is called as shares. The shares can be divided as preference shares and the ordinary shares or the equity shares. Preference share means these shareholders have preference for both dividend and return of capital. They don't take the risk of their capital, and their main aim of taking such shares is want higher income. They get fixed dividend from profit. Whenever we want to distribute dividend, firstly this dividend is distributed to the preference shareholder. Then second one is the ordinary shares or the equity shares. Ordinary shareholder or equity shareholders are the real owner of the organization. They have voting rights. Then dividend paid ordinary shareholders or equity shareholders after paying to the reference shareholder, they also required to bear the risk of their capital, and these shareholders paid highest rate of the dividend, because whenever there is a profit is earned, a fixed percentage of dividend paid to shareholder, and the remaining profit is or dividend is shared to the ordinary shareholders or the equity shareholders. So sometimes these shareholders required to bear the risk of their capital. So there is a difference between preference shareholder and equity shareholder, as equity shareholders are the real owner of the organization. Then equity shareholders have voting right. Dividend paid them after paying to the preference shareholder. They bear the risk of capital. Then we see the second part is the debenture. Debenture means a certificate or document issued by the company acknowledging the loan, and also gives undertaking to repay borrowed sum along with interest to the debenture holder on a prescribed date. Debenture holders are the creditor. They do not have voting right, and they carry a fixed rate of the interest. So debenture holders are the creditor, and they bear a certificate or acknowledgement of loan and undertaking to repay the borrowed sum along with interest. Then third one, plowing back its own profit. It means whenever profit is earned in a business, it cannot be divided or distributed, or part of them divided or distributed to shareholder or partner, and remaining part is reinvested into the business. So it is called as reverse fund. The profit earned is deposited into the business. It's called as plowing back of its own profit. The next one is a public deposit. In your business, number of public deposit their monies. For that, you require to advertise into the newspaper or various types of media with the achievement of company future plans, so that large number of people can invest their money in your company, and for that interest required to paid periodically or the end of the maturity. So due to the public deposit, we can arrange our capital. The next one, various financial institution. In India, there are various financial institutes are available which can provide the medium term and long term loan to the your business. Commercial bank provide short term loan, but industrial bank or this bank provide a long term loan to your business. First one is the Industrial Finance Corporation of the India. It was established in July 1941 with the object of rendering financial assistance to industrial concern. Then next one is the Industrial Development Bank of India, IDBI. It was established in July 1964. Its aim to coordinate, regulate and supervise the activities of financial institutes like IFCI, ICICI, UTI, LIC and commercial bank. Then next one is the Industrial Credit Investment Corporation of the India, ICICI. It was established in January 1955. It provides medium and long-term financial assistance to the industrial concern which are in private sector. Then next one, Industrial Reconstruction Bank of India. It was established in March 1985 to nurse the sick industries by providing short-term loan. The National Small Scale Industrial Corporation of India. It was established in February 1955 to promote and protect the small industries by providing financial assistance. The next one, State Financial Corporation of India. As per Indian State Financial Corporation Act 1951, this State Financial Corporation developed into India with the main object to provide financial assistance to share in the form of shares, debenture, bond, etc. The next one is State Industrial Development Corporation. Here number of state government have established their own industrial development corporation to grant the loan to the industries. Then Unit Trust of India. It was established in 1964 with the basic objective to stimulate and pull together the saving of peoples to middle and low income group. It was also enable the investor to share the benefit of the investment. So these are the various sources to obtain a loan for medium term and short term. In medium term, there is also one point is term loan or the mortgage. It is secured or borrowed loan from the bank, insurance company or any other similar agencies. It is sanctioned against mortgage or pledge of the property. It is required to return back on the payment of loan within an agreed time. Then next one is a short-term loan. There are various sources to obtain such types of short-term loan. It can be arranged for less than 1 year. It is used to meet the current expenditures like purchasing, payment, wages, etc. And these short-term loans can be obtained by trade credit, bank credit, installment credit, or consumer credit. We can see them one by one. First one is a trade credit. It is granted by manufacturer, wholesaler to retailer. It may be 30 to 90 days. It is granted to the company without any security. The credit is granted only on the basis of the goodwill and financial condition of the borrower. No interest is charges for this trade credit, but prices of the goods is larger or more than their actual price. So trade credit can be given to the retailer from manufacturer or wholesaler for 30 to 90 days. The next one is a bank credit. Commercial bank provide various credit facility in the form of short-term loans to the depositors. They also provide overdraft, cash credit, advance facility. For that, requirement of some security is necessary. Then next one is a installment credit. It is also called as consumer credit. It is arranged for selling of luxurious goods like TV, fridge, washing machine, etc. For that, some down payment is required to pay, and remaining amount is paid in the form of easy installment. Interest is required to pay on unpaid amount. Here also prices of the goods is greater than their actual prices. Then last one is the customer advances. Sometimes customer required to deposit advance to the retailer for their requirement of the goods. It may be part of the price or complete price. No interest is carried out, and period of credit is depend upon time taken to deliver the goods. So these are the four sources of the short term loan. First one is the trade credit, second one bank credit, next one is the installment credit, and last one is the consumer credit. So this is all presentation on the topic banking and finance. In this topic we see the different points like definition of bank, different types of bank, then services provided by commercial bank, the next one definition of finance, definition of financial planning, sources of finance, and types of capital. So thank you for this presentation. Thank you once again.